What you are about to watch is probably the nerdiest video you will watch today, or perhaps this month. Hey, I'm Kaleb Paddock, the founder of 10 Talents Financial Planning. We're going to be looking at numbers today, but not just any old numbers. We are going to be looking at some of the most important numbers regarding financial planning in 2021. So without further ado, I'm going to share my screen. We're going to dive into this and see what we got on tap today. So here's the deal. We are looking at some important 2021 numbers. We're going to start over here on the left-hand side. I am going to point out a few things that I think are interesting. Here are your tax rates over here. A couple important things to point out. If you are married, filing jointly, we see that column right here. If you are married and filing jointly with your spouse, you have a sweet spot if you're making some good income. If you're in this 172 to 329 category, you are in the 24% tax rate over here on the left-hand side. This is important because if you get a bonus, if you make more than the 329 number, if you land in this, 329 plus up to 400,000, you're going to pay 32% tax rate. It's a huge jump. It's an 8% tax jump. So what this means is you need to be making tax planning decisions based on that income. Do you want to pay tax now, or do you want to delay it? That's a great question and something you'd want to speak to a financial advisor about. Or if you're a CPA or financial advisor watching this, you want to headline this to your clients. The other important number here is going to be your standard deduction. So you're going to get $25,000 of standard deduction if you're under the age of 65. This is going to reduce this number over here. So maybe you make 329, but you're going to get a $25,000 deduction. So you'll only pay tax on like 304 in that example. So be aware of where you land. It matters for making decisions on pre-tax 401k, Roth 401k, an IRA contribution, Roth IRA. You need to understand, where you land for those brackets. You may notice if you make that much, if you're making above $142,800, you're going to feel like you get a raise kind of in the middle of the year, or if you just make over $142,000, because above $142,000, you stop paying 6.2% Social Security tax on your money. So some of you who may be earning above this amount may think, well, I feel like I get a little more income later in the year. That's because you are earning above this Social Security wage base. So something interesting there. I'm not going to go through every single one of these numbers. In fact, I'm going to scroll down to this point here, long-term capital gains tax rates. Let's switch to the other end of the income spectrum. Let's say you're in between jobs. Maybe you lost your job during COVID when it started last March. This is being filmed in January of 2021. And if you have less than $80,000 of income in 2021, and you have investments in a taxable brokerage account, if you sell them at a gain and your income is below 80,000, you land in a magical zone. This magical zone is known as the 0% tax rate. So this is something to consider if you're having a lower income year and you have investments in brokerage accounts. Think about harvesting gains. Could be a good idea. You'd want to run it by your CPA and financial advisor, but something to think about. Let's put you on the other end of the spectrum. Let's say you are making more money and you are retired, or let's just say age 65 or older. Here is an important number for Medicare. So if you're married, I speak to a lot of married couples, so I'm focusing on that column. No offense if you're single, but we're focused on this married filing jointly column. If you earn, or if you have income above $176,000, you are going to pay these surcharges. They're known as IRMA surcharges here. You start to see they start out at $59.40. Sorry for my mouse. I can't get that quite circled very nice. This is monthly. So all the numbers you see over here on this part of the screen are monthly surcharges based on your income. If you are in retirement or approaching age 65 and you're around these thresholds that you see on this left-hand side right here, it would be important to take a look at that and see if you could find ways to avoid certain brackets so that you're not getting hit with these. Now, important to note, you won't feel this immediately. There's a 2-year delay. So for 2021, those surcharges are based on 2019 tax return. So you won't feel this immediately, but if you're starting to creep up into these higher levels, be aware that you might see your Social Security check, if you're taking it, get reduced because of those IRMAA surcharges. The other thing I want to point out here, actually, let's just scroll down to the next section. So what we're going to look at here is contribution limits. So let's say you're working currently, you got some limits on your contributions to your 401k plan. So we got $19,500 into your 401k, 403b, TSP, EIEIO. Sorry, that last one's fake. But anyways, 401k, 19.5 if you're age 50 or older, anytime during the year. You could turn age 50 on December 31st. You still count as age 50 in 2021. You get another $6,500 you can put away. So $26,000 is the most you can put into the 401k. Now, some people may say not enough. Then if that's not enough and you're a business owner, you're going to want to think about a defined benefit plan or wait for it, cash balance plan. These are plans where you could put in significantly more than $26,000 or significantly more than this number, $58,000 in your 401k plan. So speak to your CPA, financial advisor, or third-party administrator to understand how you could use a defined benefit plan to put away significantly more in your retirement plan. A couple other things to be aware of here. You've got your traditional SEP IRA. A lot of people like these. CPAs like these. They've got similar contribution limits. There's that 58,000 number again. 25% is the limit, though, on your net earnings. So if you're self-employed, you're a business owner, you are capped at 25% of those earnings or 58,000, whichever is smaller. A couple other things to keep in mind. Over here, you've got Roth eligibility. So if you're currently putting away in a Roth IRA and making those contributions directly, then you're going to want to be aware of these limits. So if you're single, you've got that 125 to 140 phase out in terms of income, or if you're married, about 198 to 208. Just means you can't make direct Roth IRA contributions. There is a two-step Roth contribution. If you're over these amounts, call me if you're curious about that. If you've inherited money, you do need to be aware of this table over here. This is the table for if you've inherited dollars. And you need to take minimum distributions. The rules all changed in 2020 for inherited retirement accounts. So if you had a family member or a friend who died and left you money in a retirement account and they died in 2020 or since then, you're going to be using this table to calculate those distributions. You also need to make sure you get those paid out within 10 years of the date of death. It's technically 11. Again, call me if you have questions about that, but there's a 10-year payout where you have to get rid of all that money out of the retirement account over 10 years if you are not a spouse beneficiary. Call me with questions if you have them. If you are turning age 72 this year, you need to be worried about this factor table over here. This is the factor table for minimum distributions. This was changed from 70 and a half to age 72. So again, if you turn 72 this year, or maybe you turn 72 next year or the year after, or you're going to turn 72 anytime in the future, then you need to know about this, because at age 72, you have to start taking money out of retirement accounts. So I know we're covering a lot of ground here. Thank you for watching to this point. I'm just going to add comments on a couple other items. If you have a child currently in school, you want to be aware of these education tax credits. So there's this American Opportunity Lifetime Learning Credits. If you're married filing jointly, you're only going to be able to participate below these amounts, 160 to 180. If you make over that, don't worry about this. But if you make that level or below, worry about this. Make sure you're getting those credits, those education tax credits on your return. Also, health savings account. If you are participating in a high deductible health plan, you have the ability to contribute to a health savings account. These are the contribution levels that you want to be aware of. If you're not taking advantage of this, I highly recommend you consider it. This money is the purest form of income. No federal tax, no state tax, no Social Security, and no Medicare taxes. on these contributions. They are the purest form of income you can have. And with apologies to folks in California and New Jersey, you do not get to deduct these on your state income tax, but every other of the states, all 48 out of 50, except for California and New Jersey, it is pure income. And I recommend you check it out. I have articles, videos, blogs on the health savings account because I love it. Check out these numbers, folks. If you have questions, if you see something on here I haven't talked about, or you're just curious and you're thinking, wow, I had no idea that there was so much to keep in mind with financial planning, and wow, there's probably a lot of value to be had here, you're absolutely right. Give me a ring, give me an email, or shoot me a direct message. If you're watching this on my YouTube channel, which you probably are, smash that like button, subscribe to the channel, and thank you so much for watching the nerdiest video you'll probably watch this month, or maybe even this year. All right, talk to you later. Bye-bye.